Great. So you should be able to see my my desktop now as well. Just a quick word on our disclosures that the information and opinions in this webinar are for general information use only and are not intended as an offer or solicitation with respect to the purchase or sale of any currency or CFD contract. All opinions and information contained in this report are subject to change without notice. The report has been prepared without regard to the specific investment objectives, financial situation, needs of any particular recipient. Foreign exchange and other leverage products, they involve significant risk of loss and are not suitable for all investors. Increasing leverage does increase your risk. Spot gold and silver contracts are not subject to regulation under the US Commodities Exchange Act. And contracts of difference or CFDs, they're not available for US residents. So that is the key thing to remember. I also need to tell you that please note we may use Bloomberg charts during this webinar presentation. Prices displayed on Bloomberg charts might not reflect Forex.com prices. And that the Bloomberg charts tend to be are the ones with the black background. So usually I'll mention it first, but just to draw your attention to that. Now let's get started. Where are we here? This is Euro Sterling. Let's take a quick look at Euro. That's probably been, from a fundamental perspective, what people are watching. This is an hourly chart though, and as you can see, it's not really been doing too much. Yesterday was a big giveaway for that. We saw a move back to, we saw this, this is the very short-term MACD. Some people I know don't like MACDs. They can be lagging indicators, etc. But I think when they flatline like this, like it did yesterday, it's really a clear indicator to me that the market is more likely to range trade, and that was that's kind of where we've been all week, all the last 24 hours since the start of this week, whereby the low seems to be 134.75, and then the high or the gains capped around about that kind of 135.20 level. So very, very tight ranges in Euro at the moment. Why are they so tight? Well, there hasn't been too much in the way of economic data. There was German IFO today, which was slightly weaker than expected. That's having a downward impact. We also had Mario Draghi speak yesterday, and on top of that, we had the head of the Austrian Central Bank, Nowotny. He came out, and they both reiterated the same message. Now, I've said this before to some of you who've joined in the past, that the way that the ECB is managing its forward guidance. So for those of you who are new, central banks are really key for exchange rates, and central banks right now have been very, very low, very, very accommodative for a long time. So they're having to embark on a new policy called forward guidance. And forward guidance is basically trying to talk down your interest rate expectations. So saying that you're going to keep them low. People like the Federal Reserve and the Bank of England, what they've done is they've said, well, we're going to keep our rates low until the unemployment rate gets to X. That would be 7% in the UK, it would be 6.5% in the US. However, the ECB didn't do that, and at first they were criticised for it. However, and remember, having lower rates for longer should dampen upward pressure on your currency. However, in the last kind of week or so, there's been a bit of a kind of a shift in that expectation, whereby people start to think that the ECB has been quite clever by not putting an economic threshold with it. And instead, we had Mario Draghi yesterday, we've had Nowotny today, but other members of the ECB over recent weeks just reinforced to the market that rates will be kept low. And this kind of hourly candle over the last hour has been partly been created by Nowotny just turning around and saying, yeah, no, we're going to keep rates low. There's no need to tighten any policy, no way. Mario Draghi said something similar yesterday, hence you got this kind of decline in the afternoon. Now, as you can see, we're not really going anywhere fast. Now, let's take a look at this just on a broader perspective. So as you can see here, looks like we've made a nice rounded bottom there. Certainly the upside level is that 135.60 level. That was the high after the FOMC announcement last week. Remember, this time last week, everyone was expecting the FOMC to taper. Well, you know what? They didn't taper. That's been the big news. The big news this week, over recent weeks or recent days, that the Fed didn't taper. Hence that huge candle there. That was from Wednesday of last week, Wednesday evening of last week, London time. Huge candle higher on the back of that surprise Fed move. But really, since then, we've just not been able to get back to those highs. We had a bit of a flirt with it on Friday, but it just really didn't last. And it does look at the moment as if we could be making a bit of a top. The one thing that I would point out as well is this level here, which comes in around about 136.60. So about 100 pips from the high that we saw last week. And that could have got a bit dangerous for comfort. People will remember, the closer you get to 136, people will remember What happened the last time that euro dollar got back to those kind of plus 136 to 137 levels? This happened. This is a daily chart, so it just goes to show just how long the decline was, and that was because at this moment that was an ECB meeting right there on this day, and what it caused was a massive reversal. The ECB said that they didn't like the euro at 137. The market took them at its word and it pushed it lower. Likewise, we had that big decline yesterday. We had that kind of sharpish decline. I wouldn't say big decline, sorry. Sharp enough decline compared to kind of where we'd been the last few days. And that again was on the back of Draghi. So the closer we get to 136, the more nervousness there are in the market. The ECB will say, no, we don't like about this. We don't like the euro at this level. Also, there may be an extra impetus to talk down the currency, because obviously we did get the German elections at the weekend. Big win for Angela Merkel. Yes, she didn't get enough to form a minority government, but she's really in the driving seat, and that is good news for the currency bloc, good news for Europe. So where you're really seeing the euphoria, some people have said to me, well, why didn't the euro rally on the back of this? Well, I think it's largely because we've just had such a good go over the last few weeks. It's been a fantastic couple of weeks for euro, and I think it's kind of gone too far. At the end of the day, yes, Germany is very important for the single currency, but not as important as the ECB. And if the ECB have said they don't like it at 130, between kind of 136 to 137, then the market that's going to be a natural take profit zone. So that's my view. For those of you, I know some of you may have been euro bulls. I may be disappointing you there, but I do think that it's something certainly to consider if you're thinking about taking up a long euro position. That doesn't mean in the short term that we don't think it's being picked up on the bid. In fact, we do. We've certainly seen some interest come in around about that 134.75 level. That is a pivot level of support. Below that, 134.12 is the Tankan line on the daily Ichimoku clouds. And if some of you will know that I like looking at those clouds, I find them very simple to read. But that's kind of the key thing. But I do want to show you where we have seen some of that good news from Angela Merkel's re-election. Remember, she's entered a really exclusive group now. She's only one of a handful of post-war chancellors in Germany to have been elected 3 times. So, the woman has done a fantastic job. Now, this is where we're really seeing it. And this is the 10-year Spanish bond yield, continued to decline. So remember, when bond yields in Spain decline, that's just good news. It makes it cheaper for these countries, these troubled countries, to borrow. And I know some of you say, well, isn't there a problem that it's too much debt? Why are we happy when they get cheaper borrowing costs? Well, because the borrowing cost isn't just about, sanctioning a big borrowing spree. These days it's about whether or not they can afford to fund themselves, and it's also just about health. In overall investor sentiment towards the country. So that German election result really helped the Spanish bond yields, really was reflected in Spanish bond yields, I say, because it shows it's more of the same. As much as maybe certain parts of Europe don't really like what Merkel's been doing, the market does like her control and her handling the Eurozone debt crisis. And in that sense, it's managed to calm the overall bond market. So that's that put to bed, really, the German elections. Some people thought, from the beginning of this year, really, that it could be a major cause of concern or risk, and it really feels that tail risk has been eliminated, which or actually could support the downside in euro. So as much as we don't think it's going to go up any higher, we think 136 are getting into dangerous territory. Let me just bring up the euro here. We do think that, there could certainly be, so the downside may be protected, because it does seem like Eurozone issues just aren't really there anymore. So as I said, 134 to 136 could be a slightly new paradigm, or could be the paradigm that we're in now, since that kind of big punch through there, as you can see in euro dollar. Now, it wasn't just euro that really benefited from that. Take a look at this. I'm going to show you the daily cloud. I'm trying to show you the daily cloud for the Aussie dollar. Do you remember just for so long, everyone was talking about the Aussie and how weak it was? Well, you know what? It got above the daily Ichimoku cloud last week. From a technical perspective, that suggests we're in an uptrend. Now we have faltered around about this 95 level, and we're looking a little bit weak today around about this tan line on the daily cloud. 93.75 is some key support there. Below there opens the way to 92.60, which is the top of that daily cloud, and a key support level which could attract some buying interest. So right now, there isn't too much there isn't too much from a fundamental perspective to drive the Aussie this week. Remember, everyone now will be looking to at the beginning of October. That's when you get slightly more interesting data. That's when you get the RBA meeting, and you also get the non-farm payrolls. Two data points which are going to be very important for where Aussie goes next. Because obviously that payrolls report, that RBA meeting will tell whether or not, have the RBA maybe dropped their dovish bias because things in China have calmed down, things in emerging markets have calmed down, or are they still a bit nervous? Likewise, with the non-farm payrolls report, the focus will very much be on, hang on, if we get a good labour, Ben Bernanke has really pinned everything, to his, to the labour market for future tapering. If we get a real strong labour market report, then there could be tapering on the cards, which could help push up the dollar. But really, I think, that's possibly unlikely. There are concerns about the US economy right now and concerns about the strength of that labour market, which could leave kind of the dollar just in its wake at the moment. And for us, that doesn't necessarily mean that we're going to go back to those 105, 106 highs, even go back to parity. But we could certainly be in a range between kind of 95.5, 92.5 on the downside, definitely, maybe potentially as we lead up to that next RBA meeting. Now on that note, I do want to show you the dollar index. And that dollar index, for those of you who don't know, is just the dollar. It's just a really good broad overview of the dollar. Now you can trade it with us here at forex.com, and it's got kind of certainly more popular because it's the dollar against its largest trading partner. So basically what it is, it's an average of the performance of the dollar against the euro, the CAD, the Japanese yen, the British pound, the Swiss franc, and some of the Scandi currencies and some of the commodity currencies as well. And it's just a great broad overview of how the dollar is performing, and I think you guys can all tell, right? It's very, very weak. So yes, it's picked up from this bottom and managed to find a nice base around 80, but it's still very weak within its range. Let's just bring it back. Let's say take it from May, with the prospect of tapering was first on the cards. We saw some nice moves, but as you can see, really over the last kind of 5-6 months, we're still trading at the bottom of that range. So we're still looking very, very vulnerable. We're below some key, key levels. We also got that bearish crossover there with the 50-day crossing over the 200-day, which suggests that we are, which is a bearish sign. So that could kind of cap upside. And in fact, there isn't too much at the moment supporting the dollar or suggesting that we're going to move higher. The market's going to be very reactionary. It's going to be, its next move is going to be very dependent on what the Fed says. And right now we haven't had too much hawkishness coming out of the Federal Reserve. In fact, if anything, we had a very important member of the Fed speaking yesterday. And, again, for those of you who are new, central bankers, when they speak, that has a big impact on the market as well. Because they influence monetary policy, and monetary policy is one of the key drivers of currency interest rates. So what you can see here is, as you can see, we haven't really moved anywhere too fast. And actually, even on this uptrend, the candles are very, very narrow. So the range is very, very narrow. So it does suggest that maybe there's just a lack of interest or waning interest there. Maybe until we get some, the market was left in a bit of flummoxed after that FOMC decision. So it may take some more kind of fundamental drivers. And we could be fairly quiet in the dollar crosses maybe for the rest of for the next kind of, week or so until we get into the beginning of October. Just in terms of, what some of those crosses are doing. Obviously, dollar yen is always quite an important one. Oh, actually, I want to show you something else quickly. As I said, yield, central banks and their interest rates are a big driver of currencies, but so are treasury yields. And as you can see here, treasury yields are basically market-based interest rates. And as you can see here, they've been, they've just been backing away from that 3% high. They're right now back at the lowest levels since kind of early August for over a month now, about 6 weeks. And they're just looking, fairly lackluster, fairly weak. We haven't seen too much, gusto. And if you think kind of a market-based interest rate, that's how much you're willing, to compensate. That's how much people are willing to compensate for, borrowing dollars. If that's falling, it does suggest that maybe the dollar's not as much in demand. That's how to think about how market-based interest rates impact a currency. And in that environment, or in this, what you can take from this information from what the Treasury yield has been doing is that maybe the dollar's not so much in demand. As Treasury yields fall, that makes it less in demand. Likewise, obviously what the Fed has done, makes the dollar less attractive. And the reason why is that it essentially means that the Federal Reserve is still flooding the market with US dollars, which is a key thing, that's keeping a lid on dollar strength. And there doesn't seem to be any end to that right now. I'm not looking from a technical perspective, I'm not seeing any turnaround. Now let's take a bit of a look at yen, dollar yen. Dollar yen's been interesting because even after the Fed, let me just zoom in on that. That was a Fed decision. So they didn't taper. We declined quite sharply, but we didn't really decline as sharply as we did elsewhere. Dollar yen really found a base pretty quickly, just below 98, and managed to actually make up all those losses. Today, for example, it's managed to bounce off support at 98.65, which is the 50-day moving average, the pink line on this chart. It's not really extending too much on the upside, but the reason why is because as much as the US dollar is being the US dollar is impacted by kind of a dovish Federal Reserve, there's domestic issues going on in Japan as well. For example, they are in Japan, they are thinking about implementing an increase in sales tax that could weigh on growth, which could then which could then push the Bank of Japan to do more stimulus or essentially flood the market with more yen. They're already flooding the market with $70 billion, the equivalent of $70 billion worth of yen every month, slightly below the $85 billion of the Federal Reserve. But, the potential that they could do more could really keep the lid on yen gains as well. So I think that's why we're kind of moving sideways, because right now the Bank of Japan and the Federal Reserve seem to be kind of both on a mission to keep stimulus or keep the economy as stimulated as possible through their money printing. Okay, cable as well is always worth looking at. As you can see here, cable that looks like a real nice double top there at 160, 170. Again, we're still just kind of retreating from those levels that we saw. From those levels that we saw post the Federal Reserve meeting last week. We're now back below 160, but we have been kind of, by and large, we've been, oscillating between those kind of 159.5, 160.5 level the last few days, looking a bit vulnerable now. If we go below here, then it kind of opens the way to this 158.90 level, which was the low before that big rally, leading up to the FOMC session, and then 158. So that's kind of the 158 being kind of the low from the 12th of September. Certainly is in view right now. But I am, let me just annotate this 1 second. What I would take away from this chart, if you are a cable trader, is that this 160, 160 level, just keep it kind of ingrained in your mind. If we do get back up to this level, it's going to take an awful lot to punch through it. That looks like a nice double top to me, and we could be, it could suggest that looks like a temporary top, and we could be just kind of, momentum could be to the downside. I'll just pull up my other chart. We do look at that 160, 160 level. We did start to look very, very, very overbought, which suggests a pullback is due. We would say that this just looks like a pullback. Obviously, we've had a fantastic run since early July when we dipped below 150. We've had a fantastic move higher. I mean, we've moved up kind of 1,200 points since then. That's a hefty move higher, and does suggest that we could be due just a little bit of a pullback, and as I said, that kind of 158.90 to 159.10 area could act as good support from here. That would be kind of quite a normal, pullback. If I just draw some of these channels as well, you'll see what I mean. Oh. Sorry, just bear with me one moment. There you go. I mean, we've still got quite a nice channel. We're in the middle of that here. It doesn't suggest that we're at the end of an uptrend, but it does suggest there could be a little bit more downside, really to about that 158.70 level. That should, as I did mention, the bottom of that low pre the FOMC, and then below there, at the bottom of this kind of trend channel as well, could act as very good support. And then looking kind of, if we can get above this 161.70 level, then potentially getting all the way back to kind of 162.70, which would be the highest levels really of the year so far. So the highest level since December, January time, 2012, 2013. Okay, I'm going to look at gold as well quickly, because gold has been very interesting. And then I'm sure some of you want to ask some questions. So I will get you look at some questions as well. And I want to look at dollar CAD too for a specific reason. As you can see here, gold is still looking very vulnerable. We've seen a bit of a pullback in risk sentiment today. I'll show you what I mean by that. We've seen, this is basically the Indian rupee. The Indian rupee has been kind of just pushing a little bit higher. Looks like it's the dollar has been pushing a little bit higher against the Indian rupee and against the Thai baht. So basically there was a little bit of nervousness in emerging markets today. And as, obviously, that happened back in April. And kind of in the second half of August, or a big sell-off in emerging markets. Since then, they recovered. So this decline, remember, is when the dollar weakens against the Thai baht, because this is dollar Thai baht. But then today we saw a big push higher. So just in terms of from an emerging market perspective, there's a little bit of nervousness. Is this playing out in stock markets? Let's take a quick look. Not really, but we're not really making any gains at all. Instead, what we are seeing is just a little bit of overall nervousness in the FX market. And I'll go back to gold quickly. And gold is lower as well. So gold made a significant fall on Friday. It got through its prior support here, which is the 150-day moving averages, which come in at 1345, 1346. Dived through there, which opens the next level of support at 1300. We do expect the market to at least respect that level. That doesn't necessarily mean that we'll go sub that level, but in the current environment, whereby there's still a lot of easy money around, it's going to be difficult. Or there may not be as much, upside could certainly be limited, and that should be gold. That should be, well, potentially that can sometimes be gold positive. It hasn't really had that effect so far, with people actually focusing on the fact that the ECB is no way going to, do more QE, and the Fed will have to taper at some point. Goes back to that kind of ECB member's point, Nowotny, who I spoke about at the beginning. He was very clear. He said, central banks will have to start will have to start tapering at some point. They can't keep expanding their balance sheet. That's been kind of the key thing. So gold definitely looking very vulnerable right now. But that 1300 level, even that kind of maybe dip back to 1290, could attract some buying interest in the short term. With 1345 to 46 acting as very good, as very good support, as very good resistance, certainly in the short term. Richard, you came in late. My Aussie dollar. Yes, I did talk about the Aussie dollar earlier. Just quickly run back through that again. As you can see here, we're in an uptrend. I showed them the Ichimoku cloud before, but I'll look at this now. But it looks like kind of 95.5, looks like a nice double top. And on the downside though, 93.23 and then 92.70, which is the base of the daily cloud. So this here is, 93.25 level. The green line on this chart, that's the 100-day moving average. Instead, that looks like fairly solid support there. If we get below there, then the top of the daily cloud comes into play. But overall, I feel that we're still in consolidation mode with Aussie, and we will potentially be consolidating until the next RBA meeting. People are going to be looking to the RBA meeting to see whether or not the pickup in China data, stabilisation in the overall global environment is enough to get the RBA to drop its dovish or easing bias. And if it does do that, then that could get us back above that 95.5 level, back towards these highs around kind of 97.50-ish, that date back to kind of the end of May. So that's kind of the view there. Pan, you said thought about Bernard can do some tapering, but no, looks like he wants to leave on a good note. I think that's a very good point. In fact, that's what we've kind of included in our Q4 outlook, which will be released in early October. As we get closer to it, I'll give you all links. Because I'd love you all to join our webinar for that. I think some of you would be really interested to know our thoughts. And that will be in the first week of October. So I'll definitely let you know that. What's our view on dollar Swissy and dollar pound? I will just look at that. The Swiss franc yesterday was kind of sold quite sharply. And the reason why was because the German election risk had been passed over and it looked okay. I already took a look at cable, so I won't take another look at cable there. But as you can see here with dollar Swissy, the dollar just managed to find its feet yesterday around about 91 against the Swiss franc. And that's because the Swiss franc was down moderately across the board on the back of a good German election result. So it lost some of those some of that safe haven demand. And as you can see, it just looks like it's in consolidation mode. 91 is a really key level. If we don't really make any headway on the upside, then it does open the way to fresh lows of the year, really. All the lows of the year from the 22nd of May, which comes in at 90.22. Sorry, so these lows from January. I do apologise. Lows from January, which come in around about here, around about that kind of, sub 91, sub 90, about 90.5. And potentially we could actually just climb further. Oil, someone mentioned as well. Happy to look at oil. I'm going to look at Brent just for now. I'll look at both though. What we've seen with Brent crude oil is obviously there's a lot of, when there's been a retraction of fears, from the Middle East, and not even really the Fed decision could really get us going on Brent crude oil. Which again just kind of highlights to us that maybe we've kind of reached this peak in the cycle potentially in the global commodity cycle. We are finding good support though at the 100-day moving average, which comes in at 107.30. That's the green line on the chart in front of you here. But the fact that we fell very easily through 108.55 and haven't been able to get back above there, which is the 200-day moving average, is actually quite concerning. And the reason why, or what it suggests to me, is that all of this move higher here was all on the back of kind of Syrian risk, Middle Eastern risk, overall expectations of tapering from the Federal Reserve, and et cetera, just general kind of risk aversion in the market, signs that maybe the economies would pick up, et cetera. So even though economies have picked up, I think we are just going back to our old paradigm between kind of 105 and 110. So I see this just as a normalization. Obviously, there has been a pickup in economic data, particularly in China, in Europe, in the UK. That may keep things fairly steady. But remember, there has been some, very weak growth signals coming out of other emerging markets. So, I don't see us getting back to those kind of, 117 levels from, late last month, or even nearly back to that 120 level. If anything, I see us kind of trading probably for the rest of the year between 105 and 110. I don't really see us going plus say $8 either way from here. I do think that in the very short term there, we'll break below 107.30, this 200-day moving average, opens the way to kind of 106.30 and then potentially back to 105. So the base of that longer term range that goes all the way back to June. Someone's asked me to look at dollar MEX. Ty, I'm pleased that you've done that because not that many people do. What's interesting about Mexico and the Mexican peso generally is that it did fall along with emerging markets, but not nearly as much. So it was much more protected versus those emerging markets, as you can see here. It got back to its highest level since May, but it didn't do what we've seen some other emerging market currencies do, like the Indian rupee, whereby it absolutely fell off a cliff and reached its lowest ever level against the US dollar. We saw a strong recovery here. That was exacerbated by what the Fed decided to do last week. But since then, we've just been consolidating. So I think for me, with dollar MEX, I feel like we're in consolidation mode. We don't seem to be able to extend the many gains above this 50-day moving average, which comes in at 12.90. And instead, I see us really trading between kind of 12.67 on the downside and 12.90 on the upside. This 12.67 level is the 200-day moving average. That should act as key support. The market didn't like going back down there. I think that this pair is going to be in consolidation mode within a tight range, potentially between that 12.60, as I mentioned, and maybe that kind of 12.90 to 1300 level on the upside, or 13, level on the upside. I don't really see us extending gains too much above there, at least not until we get the next non-farm payrolls data. Okay, everyone at one. If there's one more question, I'll take one more. Otherwise, it was great, as usual, to have these conversations with you. Okay, everyone, thank you so much for joining today. Please do join me next week for more. And as I said, I will update you on when that Q4 update is going to take place. Q4 webinar, with our Q4 outlook will take place. Look forward to chatting to you then. Thank you, everybody, and let's join me next week for more. Thank you.